Let's rock and roll. This is going to be fun, man.
Good.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. And guys, we have a very special guest on today. He is the managing partner for Rejo Investment Group, which is actually the generation 3 of a family office, single family office. And they really focus and allocate their capital to private equity, traditional niches, leading strategies, multifamily, commercial real estate, also some real estate lending. And there's so many different things. We're going to be talking about direct deals and different ways they structure their wealth. But also one of the things is he was actually, let me just share with you, a career in the music industry as a songwriter, producer, entrepreneur, and as a president and board member of an industry trade group, the AIMP. Please welcome my next guest, the managing partner at Rejo Investment Group, the one and only Richard Feldman. How you doing today, Richard?
Yeah, thank you. That's quite an introduction. But anyway, happy to be here and talk to you.
Well, Richard, I appreciate you jumping on, and obviously we're going to dive into your guys' investment thesis as a single-family office and your ordinance and the way you operate. But I really want to kind of talk a little bit more personal here, real quick, in regards to your music background. First of all, what got you into the music? Writing, producing. What got you into that?
Well, let me think about this. How to state it simply. It was basically something, I guess maybe it's a gift. And I noticed I had it or experienced it in high school and started writing songs then. But this is in the 60s, so I go back a ways. And did various things and ended up pursuing other careers, studying psychology actually. But then coming back to Tulsa, Oklahoma, where I'm from, and got in the music business and was playing in nightclubs, really, and apprenticing, if you want to look at it that way. But that followed moving to Los Angeles. And there I started as a guitar player and realized I wasn't any good after a session with the band became Toto, actually. And I realized I was out of my league. But luckily I wrote a song that went #1, and then that moved on to a lot of songwriting, and then eventually production. And there's kind of little courses in between there. I had a roommate that invented the drum machine, and actually that kind of revolutionized music in a way, kind of the first computer elements maybe of that. At any rate, and then got into production and did that, and have always had a foot in it, more as I guess an occupation, and less so since 2000, where I focused on managing the family office. So I don't know
2000
if that answers your question.
No, it does. And so obviously we're going to get to the managing your family office now, single family office in Gen 3. But when you were kind of evolving into the music industry a little bit, obviously you guys you have done some really incredible stuff actually, and I think you're downplaying it a little bit. But I want to talk a little bit about kind of the evolution of certain skills that you feel like you've acquired during that time period of your life that helped you obviously with the activities you are doing now in regards to investing and things like that.
I'd say pretty much zero, as far as I can think of it, because it's a really left brain, right brain thing. And I have 2 MBAs, if you want to, whatever they're worth, from a school out here that I went to immediately and got. I had a degree in psychology, but then I got a degree in business from a school called West Coast University out here. Right when I came out as a guitar player, and then I went to UCLA and got a degree there in business management, and that really did help me in managing the family office. I can't think of really how the music. They're really different. The process and maybe the elements for success, or I don't see a parallel, but I imagine, if anything, getting your face torn off and having a thick skin might be maybe the only thing that's translated from that.
So resiliency, I gotcha. Okay, I was just curious if you felt like, because your creative brain, you're able to bring that creativity in the way you look at investments or strategies slightly different than, let's say, someone from Wall Street.
Yeah, I'll put it this way. In the music business, I was a entrepreneur in that sense that I didn't work in a like for MCA or Universal or Warner's or Sony, and maybe it's that independence in a way that I look at things and um, decide if it's a good move. And a good move in music might not necessarily be a good move in business, but I do look at it from perspective of maybe my own interests. And I don't mean that in a selfish way, but you know, I'll give you two things. People say these are probably two extremes here, but some people call the wealth management or financial industry the enchanted forest, where they say everything is going to be beautiful. And the analogy for the music might be something different, but someone told me it was an observation made by Randy Newman, and they were asking him, how do you break into the music business? And he said, well, breaking in the music business is like robbing a bank that's already been robbed. So,
What a good analogy.
you're
That's
kind of
brilliant.
extreme. It is a good one. You don't even exactly know what it means, but you know exactly what it means. But it's they both have their quirks. But being independent is where I guess my focus of that comment was. I don't look at things like an RIA, and I don't look at things like a multifamily office manager, and certainly don't look at things from an institutional basis. And it's a different. There's benefits and I expect negatives as well,
Mhm.
but I can do things the others can't, and I could do that as a single songwriter, as a producer.
That makes sense. Gotcha. Okay, and that's the way you kind of pivot a little bit in your perspective. That's good. Now, you obviously
Yeah.
mentioned. Go ahead.
No, no, that's it. I'm good.
Yeah. Well, let me. Obviously, we were talking about 2000 now, and then you are the generation three for running and managing your single family office and being able to work with the wealth that you have established, given down. Richard, before we dive into your investment thesis, I really wanted to talk about. We know statistically, I've had some other individuals on that. A lot of family offices, a lot of family wealth, they do not last to a lot of times through generation two and generation three, it's in the single digits, right? And definitely when you get the generation four, which is kind of where you guys are establishing. So that shows to me you guys have really incredible systems or ordinances or processes established, communication with the family itself to, all aligned. I want to ask, how do you approach it to not only on the investment side of things, which we're going to dive into, but just on the communication and the family and the ordinance that you do to structure alignment.
That's a great question, and it's one that I've come to appreciate over time. And I'll kind of readily admit we don't have it together uh, because it's going through the different generations. You have some guy that's had a liquidity event and he's just starting out, maybe with a young family. You have these issues of, do I let the kids know that there's money there and those kind of issues. But maybe we can get into this more later here. But I'll just kind of touch on it. It's been an evolution, and I think governance, which is kind of the general topic for this subject, is an evolutionary process, and I can already see it developing because I'm older now, and I hope my son. I think he has the right skill set and the relationship with the family to continue that, but it'll be a different family office. And there's many people that write about this, and it's a deep subject. And oftentimes when people talk about this term family office, they talk about the office part. They forget about the family, and it can be the end or beginning of something. But there has to be some kind of shared ethos. There's got to be a reason to have a family office, and the most obvious one is we can all make more money if we invest together, and some of the opportunities can be, well, just ticket size is one, but just being able to uncover value different ways through direct investment. That is an advantage, but everyone's got to agree that that's the advantage. And that's something that I think I'm always dealing with. And I guess I'll just put it this way very simply, distributions are a good proxy for how well it's working in terms of benefit to the group. And if you can make distributions, and in my case it's principally to co-trustee, then it works. And if that meets his goals or their goals. So it's complicated. I really hesitate to get into this because I think every family is unique with how they do it, but I don't think we have any special sauce. I think that, everyone has to deal with it in real time with the family that they have, and it gets more complicated. I've met the Rockefellers, one of the generations, and it was a very formalized organization, and I think the larger it becomes, the more formalized it must be.
So were you
codified and memorialized?
When it was handed down to you for you to take the reins as the managing partner, were you prepped from your family? Because you mentioned offline where you had a family member, or you had you were part of a family that obviously had like their names on the building and so forth. So do you feel like you were prepped for that?
Not really, but you got to realize, this term, the term what family office wasn't around then. It was just rich people, and hedge funds weren't. There wasn't a name for that. It was just managers, and so it was really early on. So it was again an evolutionary kind of thing. I think it's maybe different now because it's just become much. Let's put it this way: with the concentration of wealth in this country and probably around the world, there's a larger number of very wealthy people, and there's institutions and kind of best practices around it. There weren't then, so it was just basically me and my dad messing around with apartments and trying to. We had a thing called value line, and we try and pick stocks. It's pretty basic, really.
So it kept it very simple, but you don't feel like you were prepped, but obviously you're carrying the reins now. Do you feel like there is that preparation or responsibility to share or allow them to understand and educate on what they're receiving, so that they obviously are able to withstand the pressure or be able to facilitate more growth in the family office or preserve the wealth that you've established?
Well, there's different structures of family offices, and there are family members that run them, and then if they're large enough or it seems appropriate, then you have a CIO or someone doing it, and that has to be more structured by the very nature of it, because it's not a family member doing it, it's someone hired. So it becomes more complicated in that sense, and maybe in some ways simplified, because it's a set process, and there's best practices around that. With family members, it's hard for me to talk about this, and I go to a lot of conferences and always attend the breakouts on this, and it's usually a ball of confusion, moderated by somebody that's written a book.
I love it. Well, first of all, Richard, I really appreciate your honesty. Like, it just shows like you don't have it all together. There are certain things. It's a constant evolution. It's a constant journey. It's just figuring it out as you go. So I really appreciate your honesty in that, and facilitating the right things. I want to dive into a little bit more of your investing thesis a little bit. Like I mentioned at the beginning here, you guys focus on allocating capital on a lot of different kind of verticals, right? An alternative investing space, specifically private equity, traditional, VC. You also focus on multifamily, commercial real estate, and then I know you also do some, real estate lending as well, in that regard, debt. Now, I'm curious, Richard. First of all, the first question before we dive into each one of those verticals in your strategy is as the market adjusts, right, which is natural, right? From 2008 to now to obviously what's going to happen the next 5 years, which we don't know, to, 10 years down the road. There's always constant, ups and downs of the market, which is just an evolution of it. Though my question, Richard, is as you start seeing the market go up or go down, how does your guys' family office navigate that according to the data that is in the market currently?
Well, you got to obviously not focus on headlines and think long term. And I've often found that family offices often kind of invest, I guess, with confidence or with a majority of their assets in something that they made their money with. And there wasn't really an operational business behind our family office. So it's kind of been investing, and that really was, there were less things to invest in, less derivatives, less whatever, when we started, and that kind of was the basis. So it's kind of been, real estate and public markets, and less so public markets now, and more other investments, as you mentioned, and I can get into some of those, but I would say adjusting to things has always been something that we maybe watched, but I just want to say that what's happening right now, to me, is kind of a seminal seismic change in that we've had no interest rates for 22 years, and now we've got high interest rates and maybe going higher and whatever. And that's thrown things into re-examination. And so how we're looking at it now, I think I'm looking at it harder. I'll just put it that way. And very simply, it's been for years. You make 20 basis points in a bank, and now you can make 4.5 percentage points. We'll date this podcast by saying what it is now. But I think the volatility of just the way the future looks is going to increase, not just markets. And so I'm looking at it harder. But in the past, it's kind of not been that much of a driving force as to what's happening. For example, in the 80s or whatever, where you did have high inflation, again, real estate was a good hedge in that sense, and that's happened to be where we were. But now it's trickier, and hopefully there are other areas and opportunities to take advantage of some of that dislocation. But it's definitely something that I think you have to monitor more closely and maybe be able to pivot faster.
Well, with that being said,
there's some investments that
go
are
ahead.
longer term, and then it's a different view. No, it's all. I'm just saying there's some investments that take 7 years to mature, and you just got to hope that it's the right strategy when it comes time to wind out, or when it comes to the maturity that it needs, that you're in the right economic environment. That's the challenge.
Well, that's what I was curious, is because it's like obviously nobody can, figure out the future, but you can find certain trends of what's happening, and you can obviously see that data. And that's what I was just trying to figure out a little bit more. It's like, okay, as the economy starts tanking for whatever reason, right, and you start seeing that, how does your guys' approach start changing in regards to, like, okay, now you're not getting so aggressive in the VC, for example, and venture capital world, and you decide to get allocate more capital toward more debt instruments. Cool, wonderful, right? Because now it's more secure, you still got liquidity, whatever. Or as maybe when you're in the recession and it's really devastating, now all of a sudden you start doing direct deals, because now you start seeing all these businesses that are pennies on the dollar compared to what it was. So now you're seeing a lot of value add, and you can go in there, deploy a lot of capital in that regard. So I'm just curious, as you start seeing the market adjust, where you start, how you think about allocating capital according to the market adjustments. Because maybe 5-7 years from now, all of a sudden the market starts cranking back up, and all of a sudden those assets you bought during the recession, now their multiples are just remarkable, right? So I'm just curious, how do you look at it holistically in regards to where you're allocating capital? How does Richard think about it?
Yeah, that's a good question. I mean, I'll maybe it has something to do with my skill set and appetite for risk, but we're not like focused on extreme, let's say, opportunistic or extreme value. So, buying something distressed or investing. I just picked this as an example, but say the kind of strategies that Fortress might, offer and maybe do very well with. That really isn't what we do. But I will say this, that, some of the, say, lending strategies that looked attractive at 8% don't look so attractive now when you can get 4% in the bank. And some of the attractiveness of these lending strategies might have been that they were short duration, thus, more liquid. And you have to look at that, well, with inflation and with this return that's still sitting there, maybe that's not a place to go. So, holding cash, as negative as that is not a bad thing. Foreseeing opportunities that maybe come about because of this. And I guess maybe the other thing is, and this is maybe exemplified by a fund that we're looking at, and we've invested with them before, and the guy said, well, this new fund, it's not going to have the cash-on-cash return that you're used to, but we expect to have higher IRRs. And the way this has happened to be a kind of an opportunistic real estate play, but their idea was, let's say, in this particular, I give a specific example of this fund, and it was one of their investments is with a guy converting office space to condos. Well, that's a 4-year deal. So you're not going to make any money in the interim, but you'll make money more. And that was the kind of investments that they felt would be more secure now. And you can think of all, obviously, the reasons for office going to condo and all that. But we're looking at more investments like that, kind of foregoing current return for what we think is a risk-adjusted outcome that'll give us a better IRR. And let's face it, IRR is, violates the thing where they say, future performance doesn't mirror the past. It's a projection. And so, we can talk about how I look at individual deals, but I handicap that projection no matter what. But I handicap it less if I feel that it's the right strategy for, as you mentioned, what looks to be a harder economic environment.
Gotcha. So you're kind of really putting it into, in context in regards to what that is. You're allocating capital to funds. Now, speaking on funds, I want to kind of, footstep on this. I've noticed a lot of family offices start, allocating direct deals and, removing away from the fund approach because, of course, the management fee, et cetera. However, though, I still see a lot of individuals deploying, family offices deploying capital in the fund structure. What is your approach? How do you like to approach it? Because, like you mentioned, there are fees, but you're relying on that person's subject matter expert to deploy capital according to it. And, definitely if they have a good track record, the opportunity cost is there, right? Compared to direct deals, you have more control over it. You can exit whenever you want to. It's probably a little bit more liquid as well. But there's, it's a give and take. You have to rely on your own, due diligence, underwriting, et cetera. So how do you like to, when you're looking at both of those, and again, the fund can be allocated to VC, real estate, private equity. So that's just just kind of overarching. But those two different verticals, Richard, how do you approach that?
Well, as a broad category, I would say it's expertise or confidence in my own ability to underwrite and understanding of the basic investment, and I suspect access. So those are the three things that would, in the sense of not having the confidence in underwriting and not having the access, would be reasons to go for a fund. So, for example, we invest some in pharma, in particular orphan drugs, and I have no idea. I mean, I can read something and understand it, but I really can't figure out if it's going to work. So A, I need the diversity, and B, I need an expert. And so as such, in that area, which I do think that that's an area that's going to be benefit from the technology and the AI and all the kind of things that are happening now. I can't figure it out, so I'm going to be in a fund for that. In another case, we're doing a deal where we're buying rural warehouses. Well, I could never access that kind of stuff. I don't have the deal flow where that comes through in enough. And again, diversity is important. I maybe could figure that one out as opposed to understanding, life sciences and bio, biology. So I know more about that, but having said that, I don't have the access to it. And I would probably say this because I've had my fair experience of kind of being in fund of funds that, invest with the geniuses in the world, and I haven't had great success with that because you can kind of diversify away your alpha. So one guy does good in one environment or with one strategy, the other doesn't. It doesn't always work. But so in specific things, for example, in pharma, and I'll just say the company I've been very happy with is Cowen, and they have an investment bank that has an arm that, advises some of these companies that they're in, kind of late stage investment, and it's proved to be a good move. And I would never want to do it myself, and me picking a particular company or a pre-revenue company. I wouldn't have the expertise.
Okay, so correct me if I'm wrong. How you approach it is you will deploy capital in a fund, but that fund has to be very niche specific, and then has to be kind of later stage, and then something that you probably don't have access to it. You're not the subject matter expert, but if you obviously like real estate, since you have a lot of background with real estate, you would deploy capital and you probably underwrite that deal in that syndication. Correct? I just want to make sure I'm tracking.
That's exactly right. Unless it was something where, I don't see these kind of real estate deals, and I believe that that's an area to invest in. And in that case, that kind of rural warehouse that I was speaking of, that's where I would do it through a fund as an only option, really.
Mm-hmm. So let's talk a little bit about, underwriting process. Okay, and now we're pivoting directly to direct deals because obviously, well, you would have to do underwriting with funds as well because you have to look at their track record. So regardless of which approach that is, you still have to be doing underwriting. When you're looking at, regardless of a fund or that company or that private equity or real estate, what is your guys' approach? How do you look at it? I've heard some individuals, they rely a lot on the team and the operations team of that fund, and then obviously they look at their track record, et cetera. But I'm curious, how do you approach it? What are your some key green flags, and what are some red flags that you look for?
Yeah, you hit on two of the main ones there. But I start out just right off at first. Just I hate to say it, but is there fraud? I just start right there, and of course that question gets answered very quickly. Gets answered pretty quickly, and then from then I basically see how it fits, how the investment fits in to our overall goals in the portfolio. And there's growth, but there's also the ability to be able to pay taxes. We need cash to make distributions, to pay for the operation of the family office. So some of the investments have to go towards that. Real estate happens to work well because there's really not an option. You have a lease distribution or a rent distribution that you can't reinvest it, so to speak. But I look at it from that perspective as how it fits into the overall needs. And I guess the next thing probably is, obviously it's the strategy, but you got to assume that you're looking at something that you're interested in to begin with. But the next thing I do, you hit on it, is the team. And certainly the track record plays into that. With the track record and also with the projections, the track record speaks for itself, but is not guaranteed for the future. And it's reflected often in their projection is kind of what their track record's been, which is a safe bet from their perspective. But I discount it or I handicap it, and it's different with each deal. But I just come up with a gut. If they're saying, well, it's an IRR of 13%, 14%, I say, well, okay, if it was 10, would I be happy, and how likely can they do 10? And that could have to do with the economic environment that I foresee, or just, stuff happens. It's it doesn't always go as you want. And that also, in terms of IRR, means if the deal goes longer than, was forecast to wind out, probably there's going to be less of an IRR there, I basically look at it and see if I would be happy with it if it didn't meet the projections but met my expectations. And that's the next level that I look at. And then, there's a lot of different factors that go into it aside from that as to, I guess a big one I kind of forgot is alignment. And whether, I don't know if that's a trail or incentive, or if that's actually skin in the game. Skin in the game is a good thing. Too much skin in the game is not a good thing sometimes. If a guy's got his whole net worth in there, he's going to be maybe not thinking of it as I would. But at any rate, I want to see alignment. And I think those are the main points.
That makes sense. So in regards to skin in the game, and I've heard this where, okay, let's say you're worth $10 million, you put $1 million into the fund, and you're looking to raise $10 million. That shows to you right there for that founder, whoever it is, that okay, wow, they got skin in the game, they believe in this, wonderful, but you don't want to put the whole $10 million in there, because obviously that shows like now they're too emotionally involved, et cetera, et cetera. With that being said, do you like to gravitate away from, fund one, or do you like to, I've heard some individuals, they don't, invest in the fund ones. They want to focus on fund two, fund three, fund four, et cetera, because again, that track record comes into play. How do you approach it? Or is it more just like you mentioned, the alignment of the team and the thesis?
Well, I guess there's two factors in that, and it's really just confidence in the team. So that's why you would invest in Fund 2 and 3, because you've seen them perform. But, it's a psychological deal. I've noticed over the years, sometimes, let's just put it this way, you can invest in the wrong time, at the wrong time, rather. And so, it's one thing to be in a fund, say, and you're in there for a while, and you've been able to amass a nice gain, and it's compounded and whatever, and then something bad happens, and they're down 20%. Well, you're up 80%, so the 20% is kind of more palatable. And it's opposed to just investing in that fund, and you just picked it wrong in the first year, you're down 20%. It's really, first of all, just physically hard to get back up from the loss. But secondly, you don't have the confidence in the manager. But it's really not only about that manager, it was about the timing, because no one's perfect. People do have, cycles. And so trying to be aware of that so that you don't shoot yourself in the foot is hard to do. But definitely, I'll put it this way. There's a guy we've been investing with in real estate who is in multifamily, and we've been doing it since the late 70s, and I don't even look at the prospectus. I just do it because I have the confidence, and I have the track record, but I've also seen him pivot. I've seen him go through some problems, and I see that he, in this particular case, I'm thinking of one person, but it would be anyone like that. Then you're liable to invest again.
Do you feel, just on a side note, do you feel like IRR as a metric can be misleading sometimes? I was talking to a friend of mine, and I was looking at his track record for Fund 2. I'm not going to mention it, but they raised a $50 million, $50 million. They deployed the $50 million, and they brought in like 53, 54. So they had a good IRR on paper, but they only, netted, just relatively small compared to obviously. So I want to get your perspective. Do you find IRR can be misleading sometimes if you're not really aware of the actual, the holistic approach?
Yes, and I'm aware of that. I mean, on the margin, how much is it off? But I'll tell you this. I'm lucky to have, I guess we really talked about this, but I have my son I'm so happy to say, works with us, and he works for a solar company, and in that capacity, he's in capital markets. But basically, he has got a keyboard that looks like a gaming keyboard, and he's got like the F1 key ripped off like all the kids his age, and he's really very good, much better than I ever was at Excel. And we've done our own calculations of IRR and found them not to be the same as reported. So there's some assumptions and I guess
Discrepancies.
techniques, and I can't exactly. But they haven't been huge. But you wonder if they're not bigger in some cases where you're not catching it. And it's not necessarily duplicitous or something, but it's just how they're calculating IRR. And there's not I'm sure there's standards. I'm speaking really without authority here because I'm not a statistician and such. But I can tell you that we have found a number that was definitely lower. And I talked to the people and they said, "Oh yeah, but," and the "oh yeah, but" made sense, but they really didn't disclose that. So,
Well,
it's something
I
to be
think it's
aware
just
of.
important. Well, it's important because I literally just got a slide deck this week, and then I just started asking these questions. I was like, well, how much did you bring in? And, you start unpacking that a little bit more. I'm thinking, well, the IRR sounds good on paper, but, again, the 220, the only reason why I'm deploying capital and, holding that up for 5 or 7 years is to get a large paycheck afterwards, hopefully, right? That's kind of the whole thesis behind it. So I appreciate it. Now I want to ask you, kind of sharing a little bit of the IRR structure a little bit. I want to ask you, we've all heard the compound interest is so beautiful, and like you mentioned just real briefly, you kind of flew over it, is when you're taking dividends from real estate, you can obviously reinvest that, but in leveraging it, it goes into your pool of family office wealth. And then you have a decision. You have, push out so much to dividends of the family. Cool, wonderful. You have to pay, expenses, your CIO, whoever's involved. But then you want to take some of the cash and sit on it for other, obviously, investments to keep growing it, right? How do you approach that? What does that look like? Is it that 80-20, 80%'s distributed and 20% we keep pushing on, and or is it vice versa? What does that look like?
Well, once again, back to my son, he's formulating this into a really more systematic view. I've kind of done it from the seat of my pants, and but I will say this that I think is kind of that I have kind of come to realize I was doing it, but I came a way to kind of verbalize it was that a lot of the stuff, for example, it's called the alt, category, which is a kind of a loose term, but regardless, if you're describing that scenario in some of the cases, such as lending, where you have cash coming back in, and that can be from interest or whatever it is in trade finance, factoring, whatever, you could take that money or you could reinvest it. And you don't have that option in real estate because there's no way to put it back in. I guess there is some way, but if you have a direct investment in an apartment building, that's what it is. And it has obviously benefits in terms of its tax treatment, in terms of depreciation, whatever. In the other case, you are paying taxes on it if it's reinvested, so you have to be aware of that because it's ordinary income. But I look at it like a spigot, and it's kind of a safety valve in that sense, in that if I needed that cash, I could convert that structure that I have and forfeit the beautiful power of compounding, which is a great one, with just a source of capital if I needed it. And that hasn't occurred yet, but I like to, and as I look at investments, I say, well, this is something that is creating a current return. Let's say it's a medical receivable, 12%. No, it's not tax efficient, but it seems pretty, I don't want to use the word safe, but I can calculate and underwrite the risk adjusted likelihood that I'll have that return. At any rate, I leave it reinvested, but if I need it, I could get that capital. and that's different, say, from something like private equity or whatever, where you're maybe going to get money back, in 4 years after the investment and some of the harvest period, and that's a different type of investment, in that regard, and the compounding kind of occurs within it, especially if they recycle some of that money and you're not getting capital calls. But in terms of compounding is a good thing. I mean, we have not a lot of public market exposure, but we have some with a manager that we've been with since 1977, and I'm not a big public market fan, but I'll have to say he's a good manager. But the other benefit is the power of compounding has been, significant in its value now.
Well, yeah, and I appreciate you kind of explaining, because I'm always intrigued, definitely with, you're dealing with, you're saying family, you're dealing with the whole family, and obviously, everybody wants to get part of the pie, but also it's like, well, if you think about, projection of 5-7 years out, you get 20%, but now you get 20% of $100 million of bringing in, right? Just, give an example, right? Instead of, 20% of, $10 million, right? So it's like, hey, if we just, put all the money and all the dividends back into it, and like you said, it's just a conversation. So you're correct me if I'm wrong, it's not like there's a isolated, this is what happens in our family. It's more of just, still kind of navigating that path a little bit. Are we going to take dividends? Are we not? Hey, this year we're going to go ahead and reallocate all this stuff back to the business, and et cetera, et cetera. Is that correct? How you approach it right now?
Yeah,
It's kind of flexible.
yeah, and to be clear, my point of view is in terms of the amount of money we're managing, it's small compared to many others, and I think it needs to be more formalized. Obviously, when the greater amount of money that you're managing, and the greater amount of beneficiaries, who are looking to get distributions or whatever you have, or capital calls. The more complex it gets, I think it needs to be more formalized, and we're probably approaching that. But right now, I don't need to formalize it. But I think it definitely is something that I think about, and it gets more complex, and especially as maybe the future's more uncertain. You have to look at it that way too. These times we're living in, I think, are different than at least the times I've experienced.
You've got that right. You've got that right. Richard, man, I appreciate your time today, man. And obviously, I just had a really fun conversation just riffing on this and just unpacking your journey and how you got into, obviously, the managing partner at Regio Investment Group, and now deploying your family's capital at a single family office. And then also just your underwriting, your thesis, and the way you think about the markets as they go up and go down. And that's the, evolution of life, right? So I really appreciate you. For those that want to reach out to you, maybe just learn a little bit more what you got going on, or just follow your story, how do they reach out to you, man?
I don't think they do. I don't really. I mean, we do have a website, and it's Regio Investments, and there's a way to, I think, contact us through an email through there. I've got a pretty healthy deal flow, and I'm always willing to look at new things, but there's only so much time in the day to look at them, and so we don't go through a lot of new investments. But I'm always happy to look at things, and so they're more than welcome to approach us through that website, and perhaps through you. If someone wants to talk to you and has something you think I'd be interested in, and there's many other areas I'm interested in, including art, and I still do a lot of music. You talk about an evolutionary journey music's taken with the technology, and I think technology is kind of the root of all the changes in music. And I think look at what's going on in finance. Basically, from high frequency trading to crypto and what have you. These are all areas where technology is outpacing our ability to legislate it, and disruption is the word, and hopefully you can manage through it. But in music, it's more of an art than a science, and maybe investing's more an art than a science. Maybe we found that link here finally. It's the art of investing, not the science of investing, and it's the art of music, and maybe that's what I learned. Maybe
I love it.
That's your first
I love it.
question.
Look at that.
And
And it all looped around. That's awesome. And yeah, I love navigating the disruption, right? The technology disruption. That's always going to happen, and navigating that. Richard, I really appreciate you being on here big time. Guys, that is the managing partner at Rejo Investment Group, the single family office. My friend, the one and only Richard Feldman. Guys, that is Journey with Christian D. Evans podcast.
Thanks.
Until next time, be uncommon if you can. Thanks, Richard.